Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I am David Robson, your guide to keeping more of what you earn and sleeping better at night. Today we unpack federal versus state tax compliance for small businesses. Same income, two playbooks, and occasionally a referee you did not know existed. I will demystify registrations, nexus, sourcing, payroll, and planning moves that avoid penalties and overpayments. Grab a coffee, maybe a calculator, and let us turn anxiety into action. Why do federal and state rules diverge? Because states choose whether to conform to the Internal Revenue Code, and many adopt with decoupling. Translation: a deduction or credit that works federally might be limited, deferred, or disallowed in a given state. Bonus depreciation, meals, and NOLs are classic examples. The bottom line is cash. Your rate, base, and timing can all differ, creating surprise balances, due or losses. Planning checks conformity before spending or filing. Entity choice matters twice. Federally, a sole proprietor, partnership, S corporation, or C corporation dictates reporting and payroll rules. States add twists. Some impose income tax, others levy franchise or gross receipts taxes that apply even when you show a loss. An LLC is flexible for federal treatment, but states may charge annual fees, capital stock, or margin taxes. Compare rates, bases, and minimum fees before choosing. The cheapest federal answer can be expensive locally. Start with an fee from the IRS, then open state accounts where you operate. Typical state registrations include income or franchise tax, sales and use tax, employee withholding, and unemployment insurance. Some states bundle accounts. Others require separate portals. Do not overlook city or county licenses, home rule sales taxes, or professional permits. When you hire your first employee in a state, register before the first payroll. Clean registrations reduce notices and keep cash moving. Nexus is the word for filing obligations. It can arise from physical presence like an office, employee, or inventory at a third warehouse. Economic nexus, post-Wayfair, kicks in when sales exceed thresholds, often $200,000 or 200 transactions. Those states vary. Remote employees, sales visits, trade shows, and marketplace sales can all create nexus. Monitor by state, and once crossed, register promptly. Waiting increases exposure, penalties, and limits voluntary disclosure options. Once you file, you must apportion income. Many states use a single sales factor, which shifts liability toward your market. For services, some states source to where the customer receives the benefit, while others use cost of performance where work occurs. Online sellers encounter throwback rules. The tax sales shipped from a state when the destination is nowhere taxable. Model your apportionment early. A change in customer mix or location can swing your effective rate. Sales and use tax is not just for retailers. States tax tangible goods broadly and tax services selectively, including software, digital goods, installation, and some professional labor. Know what your state taxes, what exemptions apply, and how marketplace facilitator rules affect you. Collect and retain resale and exemption certificates before you ship. Use tax fills the gap when vendors do not charge tax. You self-assess. Account reviews prevent assessments with interest that erode margins. Payroll is 2 layers. Federally, you have income tax withholding, Social Security, and Medicare, plus federal unemployment. States add withholding and unemployment, and some require disability insurance, paid family leave, or local payroll taxes. W-2 reporting follows work location rules, not employee residency, with exceptions in reciprocal states. Cities like St. Louis and Kansas City impose earnings taxes. Correct citing avoids double withholding or missed liabilities. Use geolocation or address tools within payroll systems. Owner pay is strategic. In an S corporation, owners who work must take reasonable compensation before distributions. Underpaying wages risks payroll tax assessments. Overpaying sacrifices pass through savings. States often mirror the rule, and some apply payroll or franchise taxes that change the calculation. Partnerships owe guaranteed payments only when appropriate, and member-managed LLCs can face self-employment tax. Build a compensation study, document duties, and revisit annually as roles, revenues, and profits change. Estimated payments prevent underpayment penalties. Federally, you are safe if you pay 90% of current year tax or 100% of last year, 110% when income is high. States differ on percentages, dates, and whether safe harbors exist. Pass-through owners may owe personal estimates separate from entity payments. Calendar reminders and quarterly cash flow planning keep surprises away. When revenue spikes, adjust estimates rather than waiting for next quarter. Pass-through owners face multi-state complexity. Operating in several states often requires non-resident personal returns where the business has nexus. Entities may be required to withhold tax for non-resident partners or shareholders, or file composite returns that pay on behalf of the group. Home states usually grant credits for taxes paid elsewhere, but differences in rates and sourcing can leave tax. Track owner addresses, residency, and basis, and provide K-1s for accurate filings. Many states created pass-through entity taxes to work around the federal $10,000 state and local tax cap. The entity elects to pay an income-level tax that owners deduct above the line federally. Results vary widely. Some states require annual elections, estimated payments, add-backs, or limit credits for non-residents. If you have losses, the election can waste benefits. Model by state and owner. Coordinate with payroll and reasonable compensation, and document elections correctly. Depreciation is a conformity trap. Federally, bonus depreciation is phasing down, and Section 179 provides expensing. Several states decouple, requiring add-backs and slower depreciation. Net operating losses differ too. Carry-forward lengths, carrybacks, and limitations vary. Track state basis and depreciation schedules inside your books, not just the tax software. If you sell assets or change entities, those differences can create unexpected gains or stranded losses. Plan capital spending with state rules in mind. Credits and incentives exist at both levels. Federal and state research credits, jobs credits, investment credits, and training grants can offset tax or fund growth. Documentation is everything. Time tracking, project descriptions, contracts, and payroll records must support claims. Many states require pre-approval or certification. Miss that gate and the credit is gone. Integrate incentives into hiring and expansion plans early. A consult can align activities with eligibility before money and time are committed. Common pitfalls generate expensive mail, registering for sales tax but skipping income or franchise returns, assuming a marketplace handles everything when it only collects sales tax, missourcing service revenue or forgetting throwback on shipped goods, missing exemption certificates or ignoring use tax, hiring remote employees without state registrations, treating owners like contractors. Each issue compounds across states. Build a nexus and tax matrix by state, review quarterly, and keep policies written. Consistency prevents chaos. Documentation saves money when notices arrive. Maintain a nexus file, apportionment work papers, depreciation schedules, owner basis tracking, payroll citing reports, and a binder of exemption certificates with expiration dates. Keep copies of registrations, permits, and correspondence. Build a compliance calendar with federal and state due dates, extensions, estimated payments, annual reports, and franchise taxes. Remember that extensions extend filing, not payment. Reconcile notices monthly and respond quickly. Records shorten audits and support favorable sourcing positions. Quick Case Study 1. An e-commerce brand fulfilled from a single state crossed economic nexus in 10 states over 2 years. They assumed marketplaces covered everything, but their website handled half of sales. No registrations, no collections, and used tax liabilities accrued. We built a sales by state analysis, pursued voluntary disclosure for periods, registered and implemented sales tax automation. Penalties were waived, interest reduced, and exposure capped. Lesson learned: monitor thresholds and act early. Quick Case Study 2. A consulting firm based in Missouri hired staff in multiple states and sold projects nationwide. They sourced services to where work occurred, but states had market-based sourcing tied to customer location. We remapped revenue, discovered filing obligations in 5 states, and amended apportionment. They adopted time tracking, updated engagement letters to document benefit locations, and shifted pricing. Exposure dropped, credits for taxes paid, offset balance due, and estimates updated. Technology can help, but it is not autopilot. Use sales tax automation when you have multi-state sales, but review product taxability and nexus settings. Payroll systems with geolocation reduce citing errors. Integrations that map invoices to states make apportionment easier. Year-end moves, time equipment purchases considering state conformity, refine apportionment with updated customer data, evaluate pass-through entity elections, and true-up estimates. Small tweaks before year-end beat heroic fixes during extension season. When should you call a pro? Multi-state sales, remote employees, marketplace growth, new notices, or when tax feels like guesswork. A review can reveal savings and prevent penalties. Today we covered conformity, entities, registrations, nexus, sourcing, sales tax, payroll, owner pay, estimates, multi-state ownership, PTE elections, depreciation, incentives, pitfalls, documentation, and planning. I am David Robson, and this is Tax Smarts Unlocked. Subscribe, send questions, and let us turn tax from expense into strategy together.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.